The person standing next to you at the bank is not being charged the same fees as you. They are not being offered the same rates. When they call with a problem, someone different picks up the phone. When they apply for a loan, the number they get back is lower than the number you get back. When something goes wrong with their account, it gets fixed in a single conversation. Yours gets escalated. You are standing in the same building. You are not in the same bank. The same institution operates 8 completely different versions of itself simultaneously. What version you experience depends entirely on one number attached to your name. That number determines what you pay, what you can access, how fast your problems get solved, and whether the rules apply to you fully or barely at all. Most people will go their entire lives without knowing this. They will assume the service they receive is the service that exists. It is not. It is the service that corresponds to their level. This is what all 8 levels actually look like, and what it takes to move between them. The account is negative, maybe by $4, maybe by 400. The number almost doesn't matter because the mechanism that responds to it doesn't scale with severity. It simply activates. The overdraft fee hits within hours. $35 at most institutions. Some banks charge it per transaction, which means if 3 small charges process while the balance is negative, the fee alone is over $100, on top of whatever deficit was already there. The math of this is almost elegant in how precisely it punishes the wrong person. If there was money in the account, it wouldn't be overdrawn. But because there isn't, there is now even less. The debit card declines at the gas station. It declines again. There is a line. The arithmetic happening in real time cannot finish fast enough, and the card is still declining, and everyone is watching. This is what financial stress actually feels like. Not dramatic, not cinematic. Just a card declining while someone tries to calculate whether they transferred enough yesterday to cover this. The bank offers overdraft protection. What this means in practice is that instead of declining the transaction, the bank covers it and charges $35 for the service of not causing a public embarrassment. Some banks have moved to smaller fees under regulatory pressure. Most have not. Banks collected over $7 billion in overdraft fees in a single recent year. The majority came from a small percentage of accounts that were chronically overdrawn. The same people paying repeatedly for the privilege of being poor in a system that charges for it. There is no credit card available at this level. No loan, no flexibility, no patience, no phone call from someone who wants to help. What exists is automated. A fee assessed by a system that does not know your name, does not know the overdraft happened because a paycheck was delayed by 2 days, and does not know the charge was a gym membership forgotten 6 months ago. The system knows one thing: the balance is negative. Everything else follows from that. At this level, you are not a customer. You are a cost the bank is trying to recover. The account is back from the negative. There is $200 in it, sometimes $400, occasionally $600 before rent goes out and it drops again. Not overdrawn. Something slightly better than overdrawn, which is to say, in the category of accounts the bank services but does not particularly value. The monthly maintenance fee arrives. $12 or $15. Automatically withdrawn because the average daily balance did not meet the minimum requirement. The minimum is usually $1,500. If $1,500 were sitting untouched in the account, the fee would disappear. But it isn't, so it stays. The account that is supposed to hold money is charging money just to exist. The savings rate is 0.01% annually, roughly nothing, while the bank lends that same money out at 7 to 24% depending on the product. The spread between what it pays depositors and what it earns from those deposits is how banking works at every level. At this level, the balance is simply too small for the bank to compete for it. A credit card application gets approved, but only for a secured card, which means money must be deposited as collateral against the credit limit. Lending the bank your own money so they can lend it back and charge interest for the privilege. This is legal, this is standard, and this is how credit gets built when starting from the bottom. The service at this level is not hostile, it is indifferent. The teller is polite. The app works. If there is a problem and a call gets made, there is a hold. and eventually someone reading from a script who can solve standard problems and escalate everything else to someone who will never be spoken to directly. There is no relationship here. There is a transaction. Basic banking services are needed, and basic banking services are provided. That is the entire extent of it. At this level, the account is a small number, and the bank's interest in small numbers is purely automated. Something changes. Not dramatically, but it changes. A better job. Or the same job paying better. The direct deposit is now $3,200 a month, and it arrives every 2 weeks without fail. The bank notices, not with a phone call, not with congratulations. It notices algorithmically. The account pattern shifts from irregular and low to consistent and moderate. The system responds by reassigning the account to a different behavior category. The credit card offers start arriving. Not the secured card this time. Actual credit cards. Actual limits of $2,000, maybe $3,500. The interest rates are still high, 22 to 26%, because the credit history is short and the bank is still pricing risk. But the door is open. The institution that had nothing to offer 6 months ago is now mailing things and showing banners inside the app. The income pattern has made this account a viable revenue source, and the product suite responds accordingly. A personal loan application goes in. $5,000 for a car repair. Approved in 48 hours at 11%. Not fast, not a great rate, but functional. The process worked. Something was needed, an application was made, and it was approved. For the first time, the bank functioned the way banks are supposed to function in the stories people tell about banks. The monthly fees are gone. The direct deposit qualifies the account for a waiver. This is a small thing that registers as larger than it is, because the fees were being paid long enough that their absence feels like something. This is the first level where the account is worth keeping. The bank wants the card usage, the loan interest, the growing balance they are lending out at a spread. It matters the way a customer matters to a business, which is to say, it matters as long as the spending continues and would be placed without ceremony if it left. Consistent. Not lucky, not dramatic, consistent. The savings account has $18,000. The investment account has another $22,000. The credit card gets paid in full every month, so the 24% rate is irrelevant. A balance is never carried. What has been built through ordinary discipline over several ordinary years is a financial profile that looks meaningfully different to the bank's risk models than it did 5 years ago. Credit limit increases start happening without asking. The app shows the limit moving from $4,000 to $9,500, then to $14,000. The bank is extending more rope because the history shows it isn't needed. On-time payments. No maxing out. Low risk, high engagement. The system responds to that profile by offering more of what has already been proven manageable. Loan rates get better. The next car purchase comes with a rate of 6.8% instead of 11%. Not because of personal favorability, because the credit score and asset profile have shifted the risk calculation. The price of money is lower now because the data shows that lending money here is safe. This is how wealth compounds through the banking system, even before the wealth is large. Better rates mean paying less for the same things. Paying less means more capital stays in hand. More capital builds faster than less capital does. The system begins tilting, slowly, quietly, at the level of basis points and approval rates. At this level, there is the beginning of leverage. If a branch visit happened and moving accounts was mentioned, someone would likely make an offer to retain the business. That is a fundamentally different experience from the automated indifference of the second level. It is not intimacy, but it is the start of something. Combined assets are north of $150,000. Savings, investments, and a retirement account growing faster than expected because the start was earlier than most. Not rich by the standard of what comes later, but in the top tier of what most retail banks encounter daily. The treatment reflects that. The phone line is different. A priority queue exists for accounts at this asset level. Hold times are shorter. The person who answers is more senior. They have more authority to waive fees, make exceptions, approve things without escalating. When something goes wrong, and something always eventually goes wrong, the resolution is faster because the person handling it has the actual tools to fix it. A dedicated banker gets assigned, not at every institution, but at the better ones. A named contact appears. Someone who knows the account, emails directly, calls to check in. It sounds like a relationship. In some ways it is, though the relationship exists inside a commercial frame. The attentiveness is real. The motivation behind it is also real. Both things are true simultaneously. Pre-approved products start arriving. Mortgage pre-qualification. Investment products. Premium credit cards with actual rewards instead of the 1% cash back from before. The institution is now competing for future business, not just the current balance. It is thinking about what this account might become. This is the level where the account becomes named, known, and flagged as worth protecting. The system still has 3 levels above this one, somewhere between $500,000 and $1 million in investable assets. The definition varies by institution. The experience does not vary much. At this level, the bank stops being a place to visit and becomes a service that comes to you. Wealth management gets offered. Financial planning, investment advisory, tax coordination, and estate planning guidance wrapped into a single relationship. The quality varies significantly depending on the institution and the specific advisor. Some are exceptional, some are expensive salespeople in good suits. The difference between them costs real money and becomes apparent quickly. The conversations change texture. Consumer products are no longer being sold. There is consultation now. Questions about goals, timelines, risk tolerance, family situation. The bank is building a full picture, not out of altruism, but because a full picture allows it to offer a broader range of products and capture more of the financial life under one roof. The motivation is commercial. The experience is personalized. Both are true at the same time. Loan approvals move faster. Paperwork is lighter. Rates are better. A wire transfer that went sideways or a fraud alert that froze a needed account gets resolved in a single phone call. No callbacks, no escalation, no script. Someone with actual authority handles it in real time because the account warrants that level of response. At this level, the account is no longer a customer. It is an asset. The language in the internal system is different. The protocols are different. The distance between this and the second level is not a matter of better service. It is a different institution operating inside the same building. Above $5 million in assets, the bank begins offering things that are not publicly advertised. Products that do not appear on the website. Rates that are not posted anywhere. Access to investments unavailable to retail customers because they require accredited investor status, minimum commitments, or relationship history that most people simply do not have. The mortgage rate is lower than what an account at level 3 would ever be offered. Not slightly lower, meaningfully lower, by enough over the life of a loan to represent tens of thousands of dollars in difference. The bank competes aggressively for this mortgage because the borrower profile is almost no risk, and the relationship brings revenue across products the bank would rather have under its umbrella. The advisor at this level is not a generalist. There may be a team, one handling investments, one handling tax strategy, one handling estate and trust structures. They coordinate. They meet quarterly. The room they meet in does not look like the room where lower-level accounts wait. The chairs are better. The conversation has different stakes. The rules that govern retail banking, minimums, waiting periods, approval timelines, fee structures, access restrictions, apply differently here. Not because the laws are different, because the bank's internal policies have discretion built into them. And that discretion is exercised in favor of accounts that generate significant revenue. Private banking is a different product from wealth management in the same way a charter flight is a different product from first class. They both accomplish the same basic thing. The experience is not comparable. At this level, there is no banker. There is a private banker. The title carries specific meaning inside the institution. This person manages a small number of relationships, sometimes fewer than 20, and their entire professional focus is those relationships. They know the children's names. They know about the foundation. They know what is being built and what needs to be protected. They have direct access to decision makers inside the institution who can create arrangements that no standard product menu would ever capture. The deals at this level are bespoke. The interest rate on a loan is negotiated, not published. The investment minimum for a private equity co-investment is waived because the relationship justifies it. Documentation that would take a retail customer 2 weeks to process is handled internally in 48 hours because the people processing it know whose account it is. The rules become flexible. That statement requires honesty. Banks do not break laws for wealthy clients. What they do is exercise every legal degree of discretion available under their internal policies in favor of relationships worth preserving. Fees that technically apply get waived without being asked. Exceptions that require manager approval get approved before the manager is formally consulted. The system that was automated and indifferent at the first level is now human, attentive, and oriented toward yes. At this level, there is no client. There is a relationship. That relationship is a named line item in someone's performance review. Losing it would matter to people whose careers depend on not losing it. That is a different kind of power than anything else in this conversation. 8 levels. 1 bank. 1 name on the door. The institution did not change. The building did not change. The teller at the front did not change. What changed was the number. And the number changed everything. What it costs to hold an account. What products become available. Who picks up the phone. How fast the problem gets solved. Whether the rules apply fully or selectively. Most people assume banking is a flat experience. That the service they receive is the service that exists. It is not. It is the service that corresponds to their level. And the levels are not secret. They are just never explained. The system rewards accumulation. The more that sits inside it, the cheaper money becomes, the better the access, the more discretion bends in the right direction. Understanding that is not the same as being wealthy, but it is the first step toward using the system instead of being used by it. Now you know how it works. Subscribe and come back next week, because we are going into exactly how to move from level 2 to level 4 faster than the bank expects. The steps are specific. The timeline is real. And most people who do it say they wish they had started 2 years earlier. See you there.